Welcome back to Miller Momentum. Switching tracks and investing is never a good idea unless you're me. That's right, I'm embracing the oldest finance YouTube tradition inconsistency. Just kidding, just kidding. All jokes aside, I'm really not fundamentally altering any strategy that I'm using in my own portfolios in a way that will undermine its performance. And I'll explain all the changes I've made in detail and exactly why I made them. But first, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Okay, so quick recap. Let's talk about the Atlas portfolio first. It's a golden butterfly portfolio variant, so instead of 20% each in small cap value, a broad index fund, gold, intermediate treasuries, and long treasuries, it puts about 25% each in small cap tilted value, a broad index fund, gold, managed futures, and CAD bonds. Here's what that looks like. Now, as soon as my viewers pointed me toward more data that redeemed my view of Resolve's managed future strategy as used in return stack products, well, that changed things. I had a way to immediately do the Atlas portfolio with global market cap, more or less. I just switched my equity stack from gold to sit on top of managed futures instead. Pretty much the same portfolio, same behavior. But then I had some conversations in email and over at my Patreon with you all. And that got me to thinking, am I taking enough risk at my stage of investing? No, I don't think I am. I think I can go up to about 70% notional exposure to equities given my risk profile. So I stacked more equity back on gold and went for a more balanced split between domestic and international stocks. And here's what that looks like. I'm really happy with it. Now for the back tests. So, there are advantages and disadvantages to taking the original Atlas portfolio design and switching it to a market cap strategy or making it more aggressive, whether you want that aggression to be balanced or perhaps follow a market cap. So, first of all, you've got the Atlas portfolio I began with. You've got the global Atlas portfolio I switched to once I knew that return stacked managed futures funds were viable and also tracked an index that is extremely highly correlated with the SGCTA trend index that DBMF also tracks, albeit it doesn't track it that well, but I'll get into that later. And then we've got the aggressive Atlas portfolio, which I really like and where I landed up eventually because, well, it goes back to four tickers and it has a pretty much even distribution between domestic and international equities. And we will talk about a certain research paper that I read about that convinced me that my instinct for a 50-50 split, which I've used in other strategies I've talked about on this channel, is kind of spot on. I mean, it can vary if you're mainly in value, and it's probably not that bad to have an overweight to domestic, but all things equal, I like being equal. So, we've got our Atlas portfolio, the global Atlas portfolio, and the aggressive Atlas portfolio. And we've done the back test, and you can see that they're pretty comparable for most of their history. But during a bull run, the aggressive Atlas portfolio does pull ahead, which is really cool. Now, if you switch off logarithmic scale, they're still pretty close together. And so the interesting thing is, when you look at the rolling metrics, they're pretty much, you know, trending the same, but the yellow line, which is the aggressive Atlas portfolio, is generally on the top for the full backtest period. And when we look at our summary here, yes, the original Atlas portfolio only has a max drawdown of 27.20%. And it's not that much to substitute 13% more drop down, more max drawdown in order to get, about a 40 basis point lead. It can be worth it in terms of terminal wealth. But the magic happens when we see how well this more aggressive strategy works for accumulation. So if we're putting in, say, $800 a month into these portfolios, there's a lot more of a difference between 1.8 million and around 1.5 or 1.4. It's not astronomical, but that incremental amount matters, especially over a 20 to 30-year time frame. And I'm not having that much worse of a max drawdown. The average drawdown is not that much worse for my risk profile, and the longest drawdown isn't that bad either. Neither is the volatility for that matter. And not to mention, when you throw in the comparison of, say, the S&P 500 and the total world market here, well, take a gander. As you can see, it's beating both the S&P 500 and the total world market handily. I mean, all three of these strategies are, well, I mean, the aggressive Atlas portfolio is. Global Atlas portfolio is beating the global world total world market, and the Atlas portfolio is beating the total world market, but not necessarily the S&P 500. In any case, I think it's pretty cool that the aggressive Atlas portfolio is a balanced strategy that's 50-50 between domestic and international equity, and it's only allocating 70% to equity. And over a time period, you know, excluding 2000 to 2010, where the US was absolutely dominating the playing field, aggressive Atlas portfolio still pulled well ahead of it in the end. And that's pretty interesting. It also has a reduced max drawdown and a reduced average drawdown and reduced volatility and much higher Sharp compared to the American stock market and the total world stock market. And so, what's my goal here? My goal here is to meet or beat the absolute returns of the total world stock market with reduced risk. And the aggressive Atlas portfolio does that. Yes, it takes on a little bit more risk, but the exchanges, it has a higher probability over a 20 to 30-year time period of actually achieving that meet or beat the returns of the total world market part of the goal. So I figured that it would be worth the trade. Now, when I get up in years, I might deleverage back to the original Atlas portfolio. And the cool thing about return stacking is if you're moving what you stack around, you're not really altering the underlying fundamental strategy. So, if you exchange IAUM for GDE, uh, always pay attention to, the bid ask spread, but you can just sell gold like I did and then buy GDE immediately. And if you're careful, that few cents slippage isn't going to matter if a person is a long-term holder. So that's exactly how I did this shift from one version of the Atlas portfolio to the other. I just moved what I stacked by selling out of one fund and immediately buying the stacked alternative for it, or rather stacked alternatives when two or more funds were involved. What about the Azimuth portfolio? What happened to it? Well, Even though DBMF includes international equities and can go long or short on them, I personally wasn't comfortable with VFMO being my only pure equity holding. And I really wanted to have that interplay between value and momentum as academic factors. So I increased my equity to 70% and added AVDV. I switched to the Zenith portfolio framework. Essentially, this Roth IRA account was just getting started, so the swap won't be a big deal in the long run. Now, I did consider alternatives. So I've got pulled up on the back tester here over at testful.io, the original Azimuth portfolio, what I call the banded Azimuth portfolio, where I just take half of the DBMF allocation and just strap some international equity on for some diversification. So it's just RSIT. And then I've got the stacked Azimuth portfolio, where I also take the other part of the DBMF allocation and I put on top of it bonds. So the RSBT ETF from Return Stack. And then I've got the aggressive Zenith portfolio finally. And running the back test on these, the results are very interesting. So the aggressive Zenith portfolio uh, does roughly about as well as the original Azimuth portfolio, but it has the added twist that it's 50% domestic, 50% international. So, in a time period when the US isn't dominating, it's probably going to do better than the Azimuth portfolio because it's just not all concentrated in the United States. The banded Azimuth portfolio and stacked Azimuth portfolio did very well. Actually, not not bad at all. Pretty much on par with the Atlas portfolio aggressive version, which isn't surprising because it's about 1.4x leverage compared to a comparable amount of leverage within the Atlas portfolio. But I want this account to try a different strategy. It'll really lean into that interplay between momentum and value. And the benefit of taking on that added leverage isn't that much. I mean, you're looking at like 1.6, 1.7 million compared to 1.4 million after a 26-year investment horizon here, starting out with $10,000 and ultimately making a total amount of contributions of 265,200. So, the cumulative return on the initial lump sum is pretty comparable across the board. The max drawdown is pretty comparable. The average drawdown is what really kind of made me pause regarding the banded azimuth and stacked azimuth because that's a big increase, including a huge increase in volatility. So, out of all of these strategies, the aggressive Zenith portfolio has the lowest volatility and the best risk adjusted returns, including having, returns that are comparable in terms of their absolute value. And so it's really good. And I mean, it only has a beta of 0.52. And looking down here, during the bull run and during weak points in the United States as well, the aggressive Zenith portfolio tends to be at the top. It's only recently when the US has just dominated the stock market with those tech mega caps that you see the aggressive Zenith portfolio dip down out of the lead of these four different strategies. And, I'm not performance chasing here. I just really like the behavior because I'm trying to go for strategy diversification as well. And I think that the aggressive Zenith portfolio is the best complement to my primary strategy, which is, of course, the Atlas portfolio. And looking at the rolling metrics, you can see that again during times of US weakness, the aggressive Zenith portfolio is really high. And, based on where my day job is, I actually like hedging against the stability of the United States government because, I mean, I want it to be stable. I want our stock market to be great. Don't get me wrong, but I've already got exposure to the US economy through my paycheck. So when you're investing, ideally you want to um, hedge against your primary sources, right? For income and such. You want to take on international stock in the event that the domestic stock market just doesn't work out as well as we hope. So I really like the complementarity or complementariness or however you say it between the aggressive Zenith portfolio and the aggressive Atlas portfolio. Thanks for watching Miller Momentum. Kind of a shorter video this time, but don't worry. I've got more long and juicy content coming. It's just been a really busy week, and I wanted to give you all some insight into my recent portfolio tweaks. Oh, yeah, and I am officially monetized as a YouTube partner now. Thank you so, so much. I think I'm going to keep it simple for now and create membership tiers just to support the channel. No secret videos, no courses, nothing weird. I've also got a Patreon you can join at the link on my main channel page. We'll be doing a competition this month to design the worst performing portfolio on backtests using only ETFs with over $1 billion in assets under management. That's right, do your worst with the most popular ETFs. Details coming soon. Come join us. It'll be fun.